Hello, everybody.
Hey.
Welcome back. We're back again. We promised we would be for some kind of an. I called this an emergency stream or broadcast, but it's not really an emergency, I would say. But we're
It's yeah.
we're calling it that because it sounds urgent, and then
Well,
maybe
yeah.
people will show up. Nah, it's all good. Right. So of course, as usual, I forgot to do one thing, but now I've done it, and now we can start.
Very
So
good.
first of all, what we're going to go over today is actually we're going to go over some different points, and we're going to try to discuss and kind of dig through what's happened in the past. Let's call it half week or since I guess Friday or Thursday, because a lot of stuff has gone down, and there's a lot to talk about, and I think on Monday we made our stream was called "We're Bearish with a Smile," right?
That was last Monday's.
Last Monday.
Yeah.
And that turned into we never said that, but it turned into bearish with like uh-oh type feeling instead of with a smile, at least for me. But I think we've figured out what we at least think might take place here in the next I guess couple of months. Or weeks, or
Wow.
whatever. It's not really a big change from what we have said previously, where we've kind of said that 2023 would maybe be some kind of weird sideways move with huge pumps and huge dumps. So I'm not sure we're going to take away from that. However, it might feel like a worse version of 2022, maybe something like that.
I don't know about worse. I think it's not going to be good.
Yeah.
I think there's there's some stuff that obviously we'll kind of get into around what the effects of what's happened, where it's going to go, and yeah, there's a couple of really not good things that could come from it. The question kind of comes in really now is this is going to happen like this. If you look, we've been saying for weeks, months, it's been fairly obvious that there is a crisis brewing in the banking system for well over a year. And so now we're at this point where it's like, well, we need to see what the policy response is, because if they don't want everything to collapse and collapse big, they're going to have to respond. And so far they have responded by basically writing a blank check for customer deposits. Now that that's got a lot of implications if they want to honor that in the event of a banking crisis, because that is a lot of money which has been guaranteed, which does not exist. And so if they come along and basically backstop all of this and create trillions or tens of trillions, or I don't even know how much money it would need, and pump that liquidity into the market, essentially a pivot, if they can do that preemptively before a COVID crash type move, then yeah, you can prevent the COVID crash type move. But they've already put so much stress into the system that anything other than, and I mentioned this on Monday, and I remember in the comments, I think it was O2 Lynn said, it was like, they'd be lowering rates would be crazy. It's like, if they don't lower rates, they are exacerbating this problem, and this is now coming to a head where either they have to do something very substantial, which would be positive for Bitcoin, i.e. print several $1 trillion, or they can not, which is the most likely course, in which case big boo-boo time.
Big boo-boo time. Let's put that on a shirt. But yes, yeah, there's some stuff going down. Either way, let's just go over what we're going to talk about today, because I just want to make sure that people know what it is. So first of all, we're going to go over just real quick the CPI numbers that came out what day is it today? Yesterday. And then we're going to talk about, and I've written bank stuff, which is going to be the big segment here. We're going to try to talk a little about the USDC DPEG that happened. We're probably going to touch on some CBDCs. And we're going to try to see if we can figure out if the view of Bitcoin has changed for new eyes that have been less than interested before, let's say. For various reasons, but yes. So first of all, let's check out the CPI report, because again, that came out yesterday. There we go. Expectations were 6%. We ended up on 6%, which is good. There's no surprises there. There is no like the stock market and the crypto markets reacted like it was a nothing burger, which it is. It's an expectation. It's going down. Last month there was a bit of a reaction because it was just down 0.1% compared to the month before, and now it's down to 6%, which is a much bigger move. That kind of feels the same way as these bigger jumps were. So this is good. However, I did check on some of the other numbers. Eggs, for example, are up 55.2%, which is mind-blowingly bad. And there are other items, singular items, that are up a lot, like in the 20s and up in terms of inflation. But we're not going to dig too deep into this, though. But CPI looks like it's still doing what it's doing. The real question is, I think, what will the Fed do here? Because there's been a lot of talk, Rob, right?
Yeah, just something to mention on that. I saw the UK Chancellor gave his budget today, and whether or not we believe that the predictions put out by them, they're predicting 2.9% inflation in the UK at the end of the year, which I think is incredibly optimistic for the UK. But that kind of figure is maybe not too far off for the US.
Yeah. Well, we'll see. I mean,
we will see. It's as we've talked about numerous times, and say my kind of position regarding inflation is the majority of prices peaked between April and July. We're now in March, and that means over the next 3 to 4 months, the inflation level should start declining substantially, simply because prices, the things that make up inflation, are cheaper today than they were a year ago. They're still elevated compared to 2 years, but based on the peak price, the bubble, essentially, it's there's not really any big driver of new inflation. There's only the sticky inflation that's hung around from the last 2 years.
Yeah. But I mean, what the markets want to see, and what we want to see, what the general public wants to see, is a move in the right direction, right? And which is what we're seeing, at least for the inflation part.
The problem is we're still seeing a move in the wrong direction for rates.
Yeah, precisely. And that was what I was just going to get to, because I saw John ask the question here, and I'll put it on the screen. But he asked, what position would likely be best benefit the Fed? Them printing trillions or doing nothing. Well, let's rephrase this first, and then we can see what benefits the Fed the most. Because I think there's talk about where expectations are for the rate hike, if it's going to be 25, 50, or nothing. And if they go for nothing, that essentially means they paused, right? They paused the rate hikes, which is something that a lot of people have been screaming for a while. I think both Rob and I are on the side where it says you should have stopped that a while back, like at least 2-3 months back.
They should have started earlier and been less aggressive. They've had to be so aggressive because they waited so long. Realistically, they should have paused. They dropped rates incredibly rapidly to zero during the COVID crash.
Yep.
And then held them there for like 18 months. If they'd have been progressively a quarter every 2 months, every 2 months or so, they and got back up to 2 or 3%,
Yeah.
they'd have had a lot less room to have to move up now
Yeah.
in order to solve the issue that basically they created themselves by being too low interest rate for too long, or not,
Yeah,
not created themselves but contributed to. There's numerous factors that
yeah,
create it.
yeah. There's a lot of factors, but I think if I were the one who could decide when they like, I would have started like at the first sign of, oops, that's when you should start raising. Let's go use 25 and just do 25 a month. That's still fast.
Yeah.
Right. You could do every 2 months, but let's say you do it every month. That's going to give you a soft kind of
Softer
move up,
anyway.
softer move up, where you don't have to see this almost straight line up in the course of like 6 months, just going boom, 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 boom. And that's gonna, and mainly because it's a very lagging thing, right? When the CPI or sorry, when the rate hike happens, it takes like 6 months before you start seeing, or even a year sometimes, before you start seeing in different sectors and different fields that something is actually happening. So like some of these rate hikes, some of the 75 basis point rate hikes, they've not even started making an imprint yet. So it's like, inflation is coming down. Oh, great. And then the rate hikes start hitting, like, ooh, it's gonna be bad.
And this, if you think that the rate hikes come in, a place where this is particularly bad is in the auto sector, where you essentially have these loans that have been handed out at ultra low interest rates, and come the end of some of these are adjustable rate loans. So as the interest rates have gone up, the people's car is suddenly costing them, instead of $300 or $400 a month, which they had plenty of money during good times, all of a sudden they're paying $700 or $800 a month for their car, and it's not worth it. Well, what happens when all those cars get handed back?
Yeah. And it's like, it's not only the car, like the car industry. I know.
No, just
I
as a
have
representation.
yeah. But I'm just saying, like, I have a pretty good insight into that because a couple of friends of mine, they own a car dealership, right? And it's not. I mean, that's happening. They had to. It's not great, but the thing is, you got to think about this. Like, I think I don't have those numbers in front of me right now, unfortunately, but the consumer savings, like general savings, for people, generally speaking, have gone to basically nothing, right? So usually, I hate when I don't have the numbers, but generally speaking, let's say a classic family in let's take Sweden, because I'm familiar with the numbers in my head for Sweden since I live here. But generally speaking, like with a family of two adults and let's say a child, their general income would be something like, let's say they can save a total of $500-$600 every month between the two, right? With all the spending that has, just living expenses. That's what it was like after COVID and before COVID. And then when the rates were really cheap, and then people start living according to these standards, so they're like, oh, we can save 600. We can take a loan and get a new TV or whatever, right? And this is what people do because it's so cheap to get a loan, right? And so people just do it because there's no cost to them, really. And now
I can show you if you want.
Yeah, sure. But now, if there's a personal savings rate. There we go. It's spiked and then it just went to complete shit.
So yeah.
It's not that far away.
Mean reversion.
Yeah, it's not that far away from the mean though. The median. Actually, it is. Yeah, I can't see how many. Is that monthly or year? It's yearly.
It should
isn't it?
be.
It's yearly, and then they get the recession markings.
Monthly.
Yeah. Okay. Either way. So
yeah, it's been going up the last few months, and things have been starting to sort of slowly improve the last few months. how sustainably they're going to improve, I'm not sure. But even so, if you look at these grey bars are previous recessions, and there's never, even so, during a recession, most people are kind of just fine. They don't. Most people don't lose their jobs. Most people don't get repossessed from the house. Most people don't fall behind on their loans. It's just that an increased number of people do. And so to look at this absolutely insane spike in savings rate is like this. Why did we have an asset market bubble? Well, this is why, because people who, according to history, shouldn't have money to burn had money to burn.
I wonder if we can see actually a fun thing we can look at later. Maybe I'll write this down. But maybe we can look at, if we can find it on TradingView, personal savings rate, and then compare that, put that as a compare on like different assets to see kind of what happens across time. And when you got these spikes, if you get like a spike in the market, like Bitcoin going up or whatever, it should do. It makes sense that it should, but it would be fun to actually look at. We can look at that later. We don't have to look at it now.
We can have a look. Yeah, we'd find out. I'm just kind of trying to look. This spike in March 2021 did coincide pretty much with the Bitcoin top. And if you want to see, but this is the kind of data where we look at, if you look at November, so where we had a Bitcoin's all-time high, the savings rate was collapsing. Now, this is the kind of fundamental bearish divergence that people should be paying attention to. This is the type of stuff that caused the ends of bull markets. Basically saying, no, the party's over. What's happened the last 2 years was stupid, it was ridiculous, and it's unsustainable. And this, this should particularly be considered in terms of the altcoin market. Most of these altcoins will die, and the ones that don't die, many will never return to their old all-time highs against dollars, and the ones that do probably won't return to their all-time high against Bitcoin.
So with all that said, now I'm curious. I'll ask the audience, what are you?
We didn't really answer John's question, did we? Which position would likely best?
Well, yeah, I was gonna, okay. I'll get to that. So this is just speculative, right? But if the Fed wants to look good in the public's eyes, they will pause here. If they want to stay where, and I mean that would kind of coincide with or match up with what they have said, which is we're going to keep rates high for longer. So pausing now before they raise it too much, which I think they already have, but stopping it now and keeping it there for, like, let's say 12 months, which is, I've heard people talk about, 12 to 18 months of just holding at this level whenever they actually do pause. That's not completely far off what I think might happen too, but I think that's what they want to do, hold for like a year and a half, but I don't think they can, to be honest.
Yeah. Well, yeah, I mean, I could say that the future is in the charts, really.
Yeah.
Which, we can get into.
Yeah, we can.
Right. Now, so yeah, here's a lovely old chart which a lot of people should hopefully have heard something of, which is the yield curve inversion. Now, so the yield curve. So when people say yield curve, it is the difference in interest rates between various duration US bonds, right? So and then the different, say the curve here is the difference between these two, these two durations. So in this case, the main one that people look at is the 2-year and the 10-year, but there are inversions going on all over the place. This is just the kind of the go-to textbook example of it, where we can see pretty clearly, say historically, when so this the white line is 0 essentially. So at this point, when it's when it drops below zero, you are getting a higher yield on the 2-year Treasury than you are on the 10-year Treasury.
Which
basically
makes no
saying
sense.
people, which makes no sense. This is basically saying, yeah, if people want to lock up their money for 2 years, they get paid more than if they lock it up for 10. Doesn't make any sense. But what we can see is a pretty consistent pattern of, not 100%. Let's be clear there. A pretty consistent pattern of when the yield curve inverts, recession follows, and
Right.
we are. Yeah.
Very far below. I think that's the lowest it's been in like 50 years or something like that, which is
this goes back
insane.
to 1988. So
Right.
yeah, I assume it does go back further. But yeah, not only is it super duper duper inverted, but look at that current candle, that reversal.
Can you zoom that in just to make it super clear for everybody?
Let's just put it into the.
Put in a Heikin-Ashi or something. It looks nicer.
No, right. No, oh shit. No. Well, I think the Heikin-Ashi would take away from the. Oh, bugger off. Right, there you go. The Heikin-Ashi would take away from how absolutely disgustingly ugly that volatility is. Now, this is the bond market. This is not good. This is not what we should be seeing from essentially the most stable market on the planet. These curves should be, they should trend in a pattern. And they do typically trend in a pattern which is predictive of future economic outlook. And look at the last time we had something incredibly volatile and horrible. Oh yeah, COVID crash. And I think as it goes back, the data is a bit less.
Line chart's probably better for this, to be honest.
Yeah, it is. But still, it's. The thing to note is the problem doesn't come while the yield curve is inverted necessarily. The problem comes after the yield curve is uninverted, because what that does then signal is basically it's a collapse in the bond market. The bond market is currently backwards. It's got a whole load of tension in it, and then all that tension has to unwind, and the bond market moves back to normal. And this is. I'm about to bring up your favorite chart, and you'll love this one. Ta-da!
It looks so fancy.
It does look so fancy, but it is incredibly simple. So again, in green, we've got the US recessions, and what we see. The thick green line is the Fed funds rate. So essentially, that's the interest rate, and all of these different curves, the different lines, are the various duration yield curves. So going from the 30-year in white, we've got the 10, 5, 2, and 1. So, normally what you see is normally the 30-year yields substantially more than the 10-year, yield more than the 5, more than we see a continuous pattern of each one is in a line. This is normal. This is how markets should function. And what we do see, and we see it during these periods when the Fed has raised rates, typically when they raise rates, is you start to see this squeezing of the bond market, and this point where all of the rates end up being essentially the same. And so this is a pretty reliable, again, sort of marker of not necessarily of recession, because you can see it's happened here. It happened, it's a pretty good marker of recession, but it's not sort of nailed on. But it's a good marker of reversal. It's a good marker that what's been happening is probably not going to carry on happening. And from what we can see in how quickly we've had this stupid rally, it would make sense for that to be a rollover, and for a rollover to happen here. Now, as we see back in, let's just move these drawings, as we see sort of back in 2008, which is the last time we had a big banking crisis, we had the raises, and then we had, as we're talking about, this pause. And this pause, I believe, was it 14 months?
No, 12 exactly. I just measured it. 365 days, 12 bars.
So 12 months they held rates after they'd risen at very fast rates, and as you can see as they raised the rates, these yield curves, these different durations, all got squeezed, and they all got squeezed up to basically the Fed funds rate, and it's a sign that the market doesn't want to go the market doesn't want to go lower. The market wants to go lower, but the Fed funds rate is sort of pinning it. It's holding it up because it's saying, well, no, this is the amount of interest we're going to give you on your bonds. But the market is saying we don't want that much interest, which is a strange thing to say, but it is what it's saying. It's saying that the economic conditions don't support interest rates of 3% or 4% or 5%, and it's pretty clear we are seeing the same behavior now, where we've had we've had a top and a cool down. Now, if these bond yields do start to sort of roll over and go lower, then that is a big signal to the Fed that the rates are too high. And as inflation comes down, that their mandate, their reason for keeping rates this high, is to tame inflation. Inflation's tamed, in my view. Inflation is tamed. They've already done the taming. Now it's how much they want to break, and if they don't do this sort of reverse course, they're going to break stuff, because the
and
bond
obviously
market is telling. When you see this particular period where the rates are all below the Fed funds rate, this is all of them squeezed exactly the same rate, and now we've got a kind of this same theme sort of happening again, where these shorter durations, the 1 year and the 2 year, having gone way higher, the inversion, are now starting to come back down, and they're just going to all settle at the same sort of price, probably around this sort of 3-point-something%. And if they don't lower the rates, that's going to start putting stress on the system, because that's when it's a sign. It's a clear sign the economy can't support it.
Yeah, and this really brings us over to our next point that we actually wanted to keep, which is probably going to be the longest, or maybe not. But so this is what brings us over to the fact that Silvergate broke. Though the banks are starting to break, they're starting to crash, and one of the reasons to why Silvergate broke was because they had 10-year bonds that they had to hold to maturity, right? Which means that when people started to want to take their money out of Silvergate, what am I talking about? Silicon Valley Bank, right?
Yeah.
So people wanted to bring their money out. That meant that the bank had to sell these bonds at a loss before maturity, which just completely crashed everything. And that's basically what happened. And I'm sure they're not going to be the only ones, because usually what happens is, and this is actually something that I have to give at least some kind of thumbs up for, to the Fed and the FDIC and all these crazy people, that all of this happened, right? Banks started crashing, everything went to total chaos, people started taking the money out, and everything, the rest is history, right? And then they came out on Monday and said, we're going to bail out the depositors instead of bailing out the bank, right? So they allowed the banks to crash completely, and then the FDIC came in to take over, like a reorganization or whatnot. So they actually made sure that the customers got bailed out rather than the bank, which I think was kind of, I was like, oh, okay, that's better.
So how much?
But this stuff shouldn't happen.
How many of those customers are crazy degen gambling startup peddlers? That
there was, I think Silicon. Somebody can. Don't quote me on this number, but I believe it was 65,000 startups that they have funded.
All just been bailed out.
Yeah, but that's the thing. Like, if they were not bailed out, that would have been 65,000 companies that maybe, with potential that they would have to shut down and couldn't pay salaries, which means however many people have jobs in those companies would probably not have a job anymore, right?
Yep.
And what would happen then? Then chaos ensues, right?
Yeah,
So
but
so
this is then
basically, for once, they actually did something right, sort of. But I am under the opinion that and I got a lot of flack for this on Twitter. I said to some guy on Twitter that isn't it better if we just have a system that doesn't break, that doesn't have to be fixed with a band-aid every now and then? And then I just hashtagged Bitcoin.
you could argue that Bitcoin breaks every 4 years, so
Sure, but not because of centralized forces, I would say. But
no. Well,
either way, I just had to plug this guy with the hashtag Bitcoin just to annoy him, and obviously people went crazy. I think he called me a toddler.
oh yeah. Well, he
Uh,
got something right.
well, it's true. I mean, well, at least there was one comment, and some person that I don't know who it is said, at least it's a toddler that knows that understands the markets better than you. So something like that put a smile on my
Fair.
face. Okay, so either way, yeah, well, like, I think they stopped the contagion right then and there. Like at least a large portion of the contagion, that this would just kind of snowball effect down, and bring a lot of more
Did
banks
they?
with them. Yeah,
Did they?
that's the question, because today we saw a lot of European banks taking the hit. I did hear
Yep.
that a few other banks, American banks, went up like 55% from after the drop. That's probably just speculation. Either way, yeah, it's. I think I actually opened up.
Well, what is starting to happen, and this is obviously very early days, but this could very quickly snowball. Is there have been some instances of increased withdrawals from regional banks and increased deposits to to the big, to the giant, too big to fail national banks. And so what you're potentially seeing is a bank run on smaller banks. And
Yep.
if that happens, then this bond selling issue could get incredibly bad incredibly fast.
Yep.
Because you're going to have exactly the same issue, and this liquidity, now this is where I know you say, and I do agree with you sentimentally, in that yes, it's good that people aren't going to have their job screwed and they're not going to lose their businesses, and that they're going to be okay. They got bailed out. The problem is the simple reality of it. Not that they shouldn't have done that, but the broader implication, which is they have basically given a green light to every bank that's on the verge of failing, that all of your deposits are safe, and so that we will create as much money as is necessary to cover your deposits, and we know these deposits do not exist. So where do the deposits come from? And so what's going to happen is simply where the deposits come from is QE. The
money printer go bear.
Well, say the way QE does work, actually works, is the Fed providing providing cash balance sheets for these banks to go out and buy bonds, which will give them collateral and protect the value that's stored within them. Now, if they're trying to sell bonds to meet their liquidity requirements, and then someone gives them a load of cash, well, they can't. It's an interesting thing that they can't actually sell that cash. That isn't cash that they can hand out to you or I. This is cash which sits within the central bank itself.
Yep.
And they can basically buy bond. They can only buy bonds with that cash. So there's a kind of risk of going, what can actually be done via QE? Because sure, they can ask people to buy bonds, ask banks to buy bonds, but if the bank needs to sell bonds, well, they'll be buying with one hand and selling with the other in order to pass out to pay out the customers, and that is kind of, potentially that's the method that they'll be taking the government given money, buy bonds with it, then they'll take the investment arm money or their customers' money, sell bonds at the same time, probably of different durations. So you've got duration issues which come in, and that can cause all kinds of havoc with yield curves and just a whole host of volatility, which isn't good for or healthy for markets, price dislocations, just a complete shit show. This is the kind of thing that caused the COVID crash, where everything basically, you end up with a runaway system where everyone is parked on the wrong side of the trade. Everyone tries to get out all at once. There is zero liquidity. And so, the banks, the Fed has to come in and pump unlimited liquidity in, because this is, the thing with adding this liquidity, with adding this cash, is that goes under basically the bank's reserve ratio. The banks have to have so many assets for the amount of cash that they hold. So if the Fed pump money into them, they have to go and buy bonds with it. They've got no choice, essentially. So they're going to buy bonds. So that you're going to end up with just this trillions of dollars worth of bailout actually happening direct from the government via debt and straight into customer deposits. That's the kind of MMT, helicopter money, monetary theory potential shit show that the Austrian economists have banged on about for years. Peter Schiff will be delighted at what's happening right now, because this is his wet dream. We know Peter Schiff has correctly predicted 43 of the last 3 recessions, but is might actually be correct this time.
Yeah. Oh, I'm not gonna go on about Peter Schiff. But I did just bring this one up real quick. This is the finance side of stocks right now.
That doesn't look very good.
It doesn't look very good at all. And I think it's funny that Charles Schwab is up out of everybody, but yes. So, and then we have the same thing. Here's the crypto space right now. Not very green. So
not very.
No, and we saw this. I'll just show this real fast, just since we're already looking at my screen here. This topping candle right here on Bitcoin, and then seeing this happening. I've seen people say this is a healthy correction and everything. Like, for me, I thought this was like, oh, this is a flight to safety. Maybe Bitcoin is something that people want to, if they know they can't have the money in the bank, they're going to put it elsewhere. Where did they put it? Well, they put it in Bitcoin, and maybe that was part of this. But
I think
this
was just a
hilariously, it was a lot of short squeezes too. But still, here we have, like a very much failed breakout from this line that we've always had, right? And with everything that's going down, like when this happened, we didn't. I don't think we weren't thinking that this would be a thing. We thought something like this would be happening, right? But now with this happening, the big pump, and then a huge rejection so far, at least up here, like seeing the market starting to tumble here, and then the rest of the, like if you look at the, oh gosh, I didn't even know I had a range there, but like I just feel the market is not gonna do well here. Like I don't want to make like long-term predictions or say too much or anything, but
this is a scenario. The fundamental thing to remember is every single bank is set up like Luna, like FTX, or like like FTT.
Yes.
That is the fundamental basis of how banks are set. The difference being there is a provision to print more magic money shitcoin tokens to cover the shortfall. What the value of those shitcoin tokens will be is kind of up for debate now, but we know that the US dollar will still be the world reserve currency, even if they created tens of trillions, for the simple reason that what's happening in the US banks is happening around the world, and those global banks, those banks outside the US, They need dollars just as badly as the US banks do, and
Yep.
so they will welcome those dollars with their greedy little mitts. And
Yeah.
it's so coming back, which position would likely benefit the Fed? Well, the Fed has two mandates. So
Yep.
we'll finally answer this question. The Fed has two mandates: inflation and unemployment. Yeah, to keep inflation to around the target of 2%, and to prevent mass unemployment, or large unemployment. Inflation's taken care of. What they are doing right now, unless they reverse course, is going to massively increase unemployment.
You got to keep in mind too, though. Hold on, you got to keep in mind too, though, that the only thing they can do is demand destruction, which is what they're doing.
Yes.
So that's literally what they're doing.
How much demand is enough demand destroyed? Essentially, because their mandate is not demand destruction, their mandate is inflation management.
Yeah.
Inflation, in my eyes, is managed. It's potentially overmanaged, and now they should be starting to reverse course, because otherwise they're going to fail in their other mandate, which is unemployment.
Yeah.
And they're going to cause a big boomy crash.
Yeah, that's the creepy thing with the Fed, is that it seems like they only focus on one thing. They overdo one thing, and then once they see that, once they always late to the ball, basically. Once one starts to flip over and the other one starts, that's when they say, "Oh, let's go back." Instead of just, "Hello." I don't know what numbers they are looking at, to be honest, because it feels like they're always 6 months late.
But still, what you can see now is that they are really, really, really caught between a rock and a hard place. They are stuck no matter what they do, because if they print the trillions, say the way that they will print the trillions is, they've given it out, guaranteed all deposits. They've just said, here's a blank check for several trillion or hundreds of billions of dollars.
209 billion, I think.
No, that was just for
SVB,
Silicon Valley Bank. Yeah, they have guaranteed the deposits in policy here for every bank.
Yeah, okay,
and
that's fair.
And what we need to see now is how bad the bank run is. If these regional banks start really running into liquidity issues, and they have to dump their bonds, and they start going under, because they will be end up insolvent because they haven't got the value in the bonds to cover what they need.
Yeah.
Then the Fed steps in and gives them billions, and this is small. Many, I don't know if it's many small banks with 20, 50 billion, or big banks with 100 billion. But it's like when this happens, or if this happens, it's like either they have to let it fail or they have to bail it out. If they let it fail, as you said, 65,000 or so startups with Silicon Valley Bank, they've got their money back. That process of handing 200 billion out to people in money which is essentially doesn't exist, it's insolvent, there's no value there for them to actually, the money that they had, South Park episode, and it's gone. It doesn't exist, and they've created 200 billion to basically cover it.
Yeah,
this is going to happen time after time after time. So either the banks go under, people lose their money, people lose their jobs, people lose their livelihoods. They don't. They hand out hundreds of billions, which is inflationary. The Fed are fucked.
So here, Rob, I have an article by the Wall Street Journal that came out 1 hour ago.
Yeah.
Hold on to your hat.
So I said. There we go. Yeah.
So that's Credit Suisse. But yeah, Credit Suisse shares plunge as bank storm spreads to Europe, right? Like, this is not great.
That's not good.
It's not good. Not a beautiful chart.
The shitcoin.
Yeah, and this is Credit Suisse. It's not just it's not like a small bank.
No, not at all.
But so I just wanted to show you this chart because it was a chart, and it's. I think I'm not sure. I think that the Credit Suisse is like the second largest European bank or something like that, with 2.7 trillion something, and this is, I mean, if this is spread to Europe already and it's this severe for something like Credit Suisse,
Yeah.
like we're in for like, I hope you got seatbelts on your computer chair. Like I hate to scare people, but like this is not good.
It isn't.
I'll,
It isn't. Good.
I'll say what I've done. I'll just say what I've done here to protect myself. I've moved, and maybe I'm stupid, but I have moved basically all my funds, like my fiat, to an exchange, and I have gotten ready to buy stable coins as a first out. And if things start to go awry with that, personally, I'm going to just put it all in Bitcoin and just say, okay, F it. I don't care.
This is not then the thing. Let's and I'm not, this is pure speculation, no, fear mongering or whatever. But
yeah,
what if, as we've seen with USDC, what if the banks that have all of these dollars are the
which
ones
is
that
why
go
I'm
under?
which is why I'm prepared to do the Bitcoin part.
Stablecoin. Yeah, that's it. This then is the, can you catch it? If you look at what happened with USDC, you saw Bitcoin at 24 something thousand. Can you catch that? Nope, you can't catch the DPEG, because the DPEG will happen like boom, and then it will level off while speculators go, hang on, is this something to worry about? Should I just buy cheap dollars? And if it is going to shit, well, because there is no provision. I would say the provision for stablecoin issuers is they can halt withdrawals and say, look, we've got your money, but we haven't got the liquidity, we can't access it right now, wait.
Yeah.
And
yeah,
that is
which is
why, fine. I honestly think that's fine. They'll just be like, you can keep trading the tether. These bonds will hit maturity. If the US banking system fails and these bonds go to zero, well, guess what? Your tethers ain't worth shit anyway. So it's really not a problem. It's like, no, you're not having your money now. You can have it down the line. It would create Bankrun on Tether and USDC, but that would be fun to witness. So
again, this is why I decided I moved funds into the US dollar into an exchange as fiat.
Yeah.
If things get rocky, like if I start noticing, things go in the way it did on Friday, I'm instantly taking that into USDT. This is just what I'm gonna do, by the way, everybody. I'm not saying you do this. I'm just saying this is what I've done, because either I'm a genius or I'm an idiot.
Definitely
I'll have
an
to
idiot.
wait and see. Yeah, I'll have to wait and see. But then, if some kind of DPEG starts happening, or if you start to see, because you can see some signs on before a DPEG happens, like a day before or a couple hours before at least. At that point, I'm just moving into Bitcoin, because I feel like even if Bitcoin crashes alongside everything, at least then I know I have an asset that I believe in for the long term. Even if it goes down to 10K and I had to buy at 23, I'm like, whatever.
Oh no, that would piss me right off.
It would piss me off. It would piss me off too, obviously. But at least I wouldn't lose the funds.
Yeah, and so there's no saying, I'm with Barclays and Santander as my banks. I don't expect to lose access to my money anytime soon.
Yeah.
But this now is basically, they've set up, as I said, they've set a precedent by guaranteeing these deposits. The look of the system is that if there's a bank run, if the bank run continues, then these regional banks are going under, and they will need bailing out, or the depositors will need bailing out. And what we'll see from that is we'll see all of these smaller banks go under, and all their customers and all their money will just migrate to Goldman Sachs and Citibank and JP Morgan, and they'll continue to they'll grow as a monopoly, being too big to fail.
Yeah, there's only like 4 main banks left. I think it's in the United States. It's
6.
It's like Citibank, JP Morgan, Wells Fargo, and Bank of America, I think. And
Goldman Sachs.
they've basically bought up everything. Every failed bank, they basically buy it up. Through the years, and so it's getting more and more centralized. On top of all that, so
Rich get richer.
Yeah, it's not like I hate to say it, but I really think the just by looking at the yield curve inversion, just that for me, I've been looking at that for a very long time. I think before it even crossed the zero, and thinking, oh, okay, this needs to turn around soon, right? And it just keeps going, down. So it's like, I think it was somebody, I don't actually, it might have been you, Rob, yesterday. You said you were going to see like an ungodly crash of the system. Maybe we will.
Yeah, I tend
Hopefully
to say
not.
that though.
I mean, hopefully not, but I kind of hope so, sort of, because I want to buy stuff.
Do you want me to? If you want to just flick to my chart, my
yeah,
screen. Here's a chart of sustainability.
So,
okay, yeah. So it's a bit of a fudge. So these numbers aren't exact, but basically this is the Fed funds rate in white and the 30-year yield curve in orange. So those rates multiplied by the US government debt, which basically gives an idea of the interest payment on US debt. And we talked about this probably a while ago. I remember me and you talking about it when it was below $1 trillion. And
yeah,
at that
I
point,
remember that.
At this point, it had surpassed US military spending. We're now around 40% higher than that. And they say this is a kind of, the Fed funds rate is sort of a lower bound because when interest rates were zero, you didn't get US bonds at 0%. It was still like, it was maybe 2% or a little lower. Not good, but it's so because the debt is financed somewhere between essentially this base level and this top level, with the 30-year normally being the most expensive interest rate. So this is a kind of, this is the band of debt, and it's going to be we know it's pretty high. And so this just, you add everything up and you go, where is the money coming from to pay this stupid amount of interest? It's not sustainable. So what's that? What is a response to this? It's lowering interest rates. So you're gonna, as soon as you've got these combined forces of deposits being guaranteed, stupidly high interest rates putting a drag on the economy, and if they have to do QE, a whole lot of bond buying, which will lower yields, which will give them room to lower interest rates. It's inevitable that rates go down significantly, probably straight back to zero, and we're all screwed. So let's just enjoy it.
Yeah, so I'm just putting together a little bit of a chart here just for fun, because I know something that I missed out on doing, and this is not going to be financial advice, but there was something that I was planning on doing when I heard they started to raise the rates. I was planning to call my bank and lock the rates for X amount of years to kind of dodge those expensive mortgage payments with extra rates, right? But I never did. I was like, I think this is going to be pretty quick, so it's not going to be worth it. And boy, was I wrong. So I'm just measuring something out just real quick here on my chart. Oh, crud. So what I'm doing is I'm just measuring the time from when the rate hikes started in the two previous. Why is it so? God, dang it!
What are you showing us?
Hold on, I'll share my screen here. So I just measured. I wanted to measure this period from when they started raising it to when they went back to zero. It's 1,644 days, and this one is 1,600. 13 days, and I just realized that it's showing the last pieces here. They're showing monthly instead of yearly, so I'm just trying to pull it all the way.
Okay, yeah, I don't think that's going to be very valuable. You could just
No.
work out the date.
Yeah, I was hoping I could do like a quick measurement like this, but I realized that it goes for the monthly here. But no, so if I had done this before, which I had, but I never did this. As soon as I saw the rate hike starting to happen, and things starting to go into what the Fed is doing right now, which is raising the rates all the time. If I would have locked my rates here and said, "Oh, I'll lock them for 5 years at 2.5% or something," then I would have stopped right here with my mortgage rate, instead of having to sit up here, say they hold this for a year, and having all these super expensive mortgage payments, or more expensive mortgage payments. So maybe this is something that, I don't know, for people that have a mortgage, maybe it's worth keeping an eye on this chart just for that. You know what I mean?
It's a lot of people have talked about
It feels
reversal
simple.
of this chart. This chart is going to, it's ushering in an age. It's a reversal of a 40-year downtrend, and rates are going to be a go up, and we're going to have high interest rates for the next few decades. And to that, the answer is, well, what planet are you on? Because what's the motivation, and what's the how are they going to maintain these high interest rates when they simply cannot afford to pay them? And this is too high, too fast, and everything that makes an extreme move ends up completely mean reverting. And you can just see that straight what you've got on the screen there is a perfect example of that the market cannot handle higher interest rates, and B, every time they try and raise rates, they fuck the system up, and it ends up going back to zero. That is what we've learned from the last 20 years of Fed policy. And what they're doing right now, either they are saying that they're being stubborn and they're going to stick to high interest rates for a long time. And I'm sorry, I'm calling bullshit. It's just not.
I don't think they can.
It's not.
They're not going to be able to.
They can't. They absolutely can't.
They absolutely can't. I would be surprised to see them be able to hold even a year like they did here. That's a year. Like, I would almost expect to see one of these peaks, the icicle peaks, like just chip down. Because I'm not very confident in the Fed. Let's just say
it's a case of when things break. It really is, and things don't have to break just yet. You say, we may not have a load of bank runs that cause a problem. That that might be that. Yes, there's a few billion that move, and they have to do some quick liquidity provisions, and then they pump some QE in. They do some QE, and then they reverse it in a few months. It's possible that they do something very nice and sensible and not too overboard. But if there's too many if there's a bank run, they're absolutely screwed, and there's not a job they can do about it.
And that's the thing. Like, we're in it right now, because the Bankruns just started on Friday, basically.
Yeah. So how bad does it get? Well,
yeah, precisely. We can only wait and see. Like, what happened last time we had a huge bank run, right?
Yeah, and that's we've just lost a $200 billion bank.
Yeah.
How many billions are there? That you got to remember, it starts small. It starts with one. We've had a big bank big banks go in Silvergate and Silicon Valley, but it's these smaller dominoes that could fall that end up putting the stress on the larger ones and causing them eventually just to collapse.
So I'm just going to do this with the S&P.
Yeah, Billy, we had a look at Credit Suisse. Before.
We did, yeah.
Oh, crap. It's not good. Not good.
Not good at all. So I'm just doing this for the sake of I want to. Let's put it to. I'm gonna overdo this just for fun. This is the S&P, and you can look at the Nasdaq too and all that. But here we go, right? We have a 50% drop in the S&P 500 back in 2001. That's the dot-com bubble. Here we have the housing market crash in the United States and the global recession. Big one, 57.6%. Here's what we're currently doing right now, which is just a quick measurement for the S&P. It's down 27.5% at the bottom, current bottom. Right now, it's down less than that. But if we get like the same type of thing when there's bank runs and everything just goes to complete and utter bleh, and we get a big recession like here, then maybe this is actually possible. That's COVID bottom levels. And I told you this. I said this to you a long time ago, Rob. I was like, "What if this happens?" Do you remember that? If this happens,
Yeah.
like that's a long way to go. That's another from right now. If it goes there, it's 41%. That's more than we've dropped so far at the current bottom. I'm not saying this is going to happen, but last time we had an event like this, that it kind of happened, and I put it at 53% here, which is kind of in between what these two were in severity. Can it happen? Maybe. Will it happen? I don't know. Ask Balino, he probably knows. And by the way, now that Balino is here as well, you guys, please ask 1,000 questions. Like we're more than happy to talk about anything really, and give us your thoughts as well. Like if you think that we're completely wrong about something that we're talking about, please let us know. Like we want the discussion. That's why we're doing this, or partly at least. But yeah, if we get the same kind of bank run, if we get the same kind of hyper crash or recession type thing here, and it really goes completely crap, then yeah, I can personally see that. I hope not, because that would be very bad for a lot of people. I don't want people to get hurt. Simply put.
Yeah.
I'm seeing here, Balino.
So
Burry said we're gonna bottom in 3 weeks. Michael Burry.
Okay.
Okay. I mean.
Oh no, his prison stocks are doing.
Know why. Yeah, I don't know why how you could say 3 weeks. With everything I'm seeing, I don't know if I would agree with that. I don't really see why it would be 3 weeks. I'm sure he gave some kind of explanation to why, but
I would wager, not say having not seen the tweet, but I would wager that the explanation, if he gave any, will be things are about to break now, today, this week. We're screwed. This is it. And in 3 weeks' time, that's when the suddenly we get several $1 trillion worth of QE promised. And yep, market's bottom, and that is it. Off we go. Off we go again.
Yeah.
Rerun.
Yeah.
Let's just now let's.
So I'm just doing measurements. So I don't even know why my screen is up.
Well, if you want to just put mine, mine on.
Yeah. There we go.
So this is another look, another way of looking at what you said, which is, so when we talk about, let's see, how far does this go back? It goes back to that. When we talk about the amount of money lost this year, is what we're not accounting for there is the bond market. And yes, this has been a relatively small drawdown of the S&P. It's not been we've got minus 60% drawn back there. But if we just do, what did we say it was? 26%. And so, but it's 27%. By the way, this is. Let me just put this back on full. This is my favorite chart of the S&P, which is the S&P divided by the M2 money stock.
Yeah.
Which does reveal that what we have been in for the last 5 years is a hyper volatile, incredibly disgusting sideways range.
Yeah.
And not much more else. Even here, the stock market is back where it was in December 2014 or that kind of area. You can go back. The stock market hasn't gone anywhere in 20 years. in terms of the money,
Purchasing
supply.
value.
Yeah. Now, but what's either way, what's the kind of the sort of thing to look at is say this is the bond yield, but I've inverted it.
Okay.
So basically when the bond yield goes up, so this is for the 1 year government bond. So when the bond yield goes up, what that means is the bond price has gone down. Because if I offer to lend you money for a year at 5%, I'm going to give you $100 now, and in a year you're going to give me back 105, and you give me a piece of paper that says I owe you $105 on this date. But once you've issued that this piece of paper can be bought and sold freely, and it can move where it wants to go, and so the price of this essentially IOU can fluctuate, and if it drops, then the yield goes up. So what we've seen here is this is the actual 1 year interest. The interest rate that's been paid, it did hit 5%. It was in 2021 down at 0. So that is a huge increase in yield, and what that means is it's had a huge drop in value in the actual underlying price of the bond. So this doesn't generally happen. I think actually I can probably get the US 30 year. It won't be as dramatic, but yeah, it'll show us a bit more room.
So many charts.
So many charts, but why is this not working? Right, anyway, we can see there you go. So we can see during at least these past, these previous recessions, the bond market tends to go up.
Mm-hmm.
In that, if you look at the yield tends to go down. Therefore, the price is going up. So the stock market goes down in a recession, and the bond market goes up. We have had, for the first time in history, and it is literally the first time in history, where stocks and bonds have been in a bear market together at the same time. And
what does it
so
mean?
what you normally have is you have money being withdrawn from the stock market and being recycled into the bond market, the safer money going in there from there, money going in there from there. This time, this is indicating there is a major problem with the system, because people do not want to turn to US government debt as their safe haven. They don't want to. That is what this chart says. There is a lack of availability of buyers for the amount of debt which is being issued. Right. And that has led to an absolutely ungodly amount of wealth destruction last year. So if you take that into consideration, this drawdown of the S&P, or this drawdown of the S&P was pretty bad, because the bond market took the slack it took some of that fall. Whereas in previous times, the bond market is saying, yep, you can crash as hard as you want because I'm going to take all your liquidity, and people would just be selling their stocks and buying bonds. This time, they're selling the stocks, they ain't buying the bonds. And that is a problem. And so if there's nobody to buy the bonds, who buys the bonds when the bonds need to be sold to meet the money?
The question is also, where is that money going then?
It's evaporated.
Yeah,
it never existed. This is this is why the fact that Bitcoin has metrics such as realized cap is so valuable, where you can actually see the price that every single Bitcoin was traded at, and see the real fundamental value of the entire network. This is how much money has actually been put into this system. We don't. The valuation is built off nothing. It's built off faith. It's built off fiat. There's a promise to pay and nothing more. So where does the value go? Poof! It disappears, or it goes to buying someone's. It goes to buy someone's yacht. You've got to think these bonds are, and this is the other problem with bonds when the bond market drops, is these bonds are collateral for banks to issue loans. So when the price of the bond falls, banks can't issue as many loans. So inevitably that is a going to lead to a reduction of new loans issued, and loans tend to lead to growth because people spend their loans.
Yep.
So it's you've got this whole mess of just nonsense. That's it's going to break. It has to break.
It's already
one
started
way
breaking.
or another. It's just which way it breaks. It really is a case of which way it breaks.
Well, so okay, so
it can it can break up. This is if they decide it's QE infinity, we're bailing out all the banks, we've had enough of this, it's off we go, interest rates back to zero. That's a break. That's a break of the system, and the price, the break of that system will send assets flying. The alternative is a potential collapse in assets and a collapse in the economy. Now, which one is the worst case scenario? Well, for real people don't care that the rich people in the world are getting richer, because guess what? They know they're going to get richer anyway. So in when the shit hits the fan, it's how well looked after are the little people going to be, and probably not very is the answer, because they ain't no money.
Yeah. Okay. Either way, we did get a response from Bellino there. He said, "Here's the tweet from Burry. It says, in October 1907, Knickerbocker Trust failed due to risky bets, sparking a panic. 2 others soon failed, and it spread. When a run began on a healthy trust, JP Morgan made a stand. 3 weeks later, the panic resolved and markets bottomed. A stand was made this past weekend." So, okay, so I don't know. Okay, so the turn of events might be similar, right?
So basically, Michael Burry has just said this is the pivot.
Yes, that's what he said, and I can agree that there might be something that they will do here, but so what I tend to think about when I see things like this is, okay, so he's comparing 2023 to 1907. It's a very different world. It's a very different system, a very different tools that can be used. So saying that the same thing will happen just because it happened one time in 1907 seems a bit far-fetched to me.
History never repeats, but it rhymes.
Yeah, I was just about to say that. Yeah, and then there's a reason why this guy deletes his tweets.
Absolutely.
Precisely.
Or deletes his whole account.
So I think it's very hard to say that, oh, this happened once before 110, 50, 115 years ago, so it's going to happen now again. Definitely, like, no. Obviously, people that have been in this space for a while, and Bellino, you have been here for a while too. You know that it's just
Fugazi. Fugazi.
You can't say these things. Like I'm very difficult. Very difficult
with my. Right.
I'm very careful with my words when I try to say things, because I don't want people to get the wrong idea, thinking that I'm saying, oh, this and this is going to happen. It's like, we can speculate all day long, and we can discuss this. Like, this is why we have these longer streams, so that we can sit here and discuss these things with you guys, so that everybody can get to some kind of conclusion together and what we think might happen, instead of one guy sitting down and saying, oh, this is going to happen. Like, that's not a healthy way of thinking.
No.
If you want to have a good grasp on what's going on, you got to sit down and discuss it with people, preferably as many people as possible with different views and different thought processes, which is why we have this thing called Crypto Talks, right? It's called Crypto Talks, not Phil and Rob talks crypto. It's Crypto Talks. We talk. Everybody talks, hopefully.
Bellino talks. That's good.
And Bellino talks, yeah. He spams. God damn, Bellino.
Keep spamming. Keep going. Keep going.
Yeah, keep spamming. Spam. Use caps lock as well. But yeah, so let's kind of drop this for now. I think, Rob, we did want to touch real quick just on the USDC DPEG.
Yeah.
And what happened, and if so when it happened, people obviously started freaking out real fast. And I know that there's a lot of people, one of which a person that I know, who sold, who felt the, let's say, like the
Felt the
UST,
FUD.
the Luna UST thing happened. That was a spiral of death, right?
Mm.
And with fears that that would happen again with USDC, this person sold, or got rid of, or like basically swapped their USDC into USDT when USDC was at 90 cents.
Yeah.
And it has since then repegged, so 10% was lost.
Yeah.
Not a great feeling, obviously. Personally, I think that I would probably have, I wouldn't have been surprised if I did the same thing, because losing 10% is better than losing everything at that point. So I think being upset about that, that type of thing happening, I think it's like you probably did the right thing, even though you lost some money there. But I wouldn't be too upset about it, because it wasn't really the wrong decision either. Because losing 10% is like, okay, it's 10%. Losing 100% is kind of, ow.
Yeah, if you didn't know what to do, then sometimes nothing is the best thing to do when you don't know what to do. But
like I'm just saying, taking a 10% haircut is better than chopping your whole head off.
Yeah.
So,
and it wasn't unfounded. This wasn't. This was a crisis which could have boiled into a full-blown crisis if a proper and significant bank run on USDC happened. The same would happen. They would be forced to sell their shares at a loss. Their treasuries at a loss, and they could potentially have run into solvency issues. That's perfectly viable. Now, has it happened? Well, not so far. If we just take a look at USDC's market cap, it's down from.
I think they lost a couple of billion in market cap, but it's like.
So what is it? From Friday, it's down from 43 to 38 billion. So yeah, they lost. Yeah. So
there we go.
The peak up there at 44. Currently at 38.4 billion.
Right,
and that's
right.
if you look for relatively, it was up at 56 billion. So
yeah, this is not going to kill Circle.
No, but it could have done if if this began. So say Binance suddenly decided that they were going to start liquidating, that they were going to Binance CZ's just like, yeah, screw it, I'm going full bad guy, I'm just going to blow up Circle because I can, and he started selling USDC by the billions into this drop. He could cause a liquidity crisis, which could have potentially dragged them under if they couldn't meet the redemptions. But yeah, as I said, they could have just halted redemptions and gone, we've got your money, but it's illiquid. You understand this. Here are the public numbers. Chill, wait, because those treasuries are generating a yield. So they should, in theory, they're making on those dollars, on these dollar stable coins, they're making 4% on 38 billion. That's a lot of money. Or on 30 billion or so. They have a lot of money that they're generating, and so they could well be perfectly liquid even without that 3 billion. They may have more money in their accounts than they have.
Yeah, for sure. I think it was just one big scare. It's like one of those things. There's like the Luna thing is still being remembered, and I can definitely understand that there was a lot of freaking out happening, because it looked very similar, right? In many aspects. So, but either way, just to clarify, everybody, USDC has since repegged, and it's like nothing ever happened basically at this point. Personally, I've not really used USDC that much. I prefer Tether for a number of reasons. One of which is it's offshore from the US, and the US is being weird right now with crypto, and I'm being nice when I say weird. I would like to say many other things, but I will not. So, but it's funny though, if you think about it, right? And I think you will agree with this. I think everybody will agree with this actually. USDT has been under scrutiny for a long time, like
Oh yes,
basically years at this point, for a number of things. And it's like, oh, it's gonna go to shit zero. This is not gonna work. It's gonna blah blah blah. And then the competitor that people said would be the one to crush USDT, and it did catch up, was USDC. And when USDC then depegs, and I think DAI depegged by 4 or 5% as well.
yeah,
and a number of other coins as well. Yeah, it's significantly backed by USDC. Yeah.
With USDC.
Absolutely. Yeah, so we saw basically almost at least I think a dozen stable coins across the board got depegged at the same time there. And USDT, it got depegged too, but in the other direction. So think if you think
yeah, it didn't have a jump up.
We got 105 cents per dollar or something like that. But yeah. Okay, so I don't think we need to.
So what
have anything for USDC?
No, just it did generate this. So for people that don't understand how DAI works, is basically like you can, in order to issue DAI, you have to lock up basically collateral, and then that gives you. So then basically, yeah, you've created new DAI by paying off this ETH. So if the value of DAI drops to zero, then it means that people can basically redeem DAI for cheaper, like using less collateral. So it kind of encourages them to take, and you've got people who've got DeFi loans. If DAI drops to 90 cents, if you've got a loan in DAI, you can take your tether at 105, swap it for DAI at 90, and use that to pay off the loan. And you'd have made 15%. You pay off your loan at a 15% discount.
Yeah,
brilliant, absolutely fantastic if you can do that. So these.
Not so fun for the ones who's grabbing that.
If you're somebody who messes with DeFi loans, or somebody I have in the past, given that these kind of events can sort of happen sort of maybe once a year, it's not necessarily a bad idea if you are somebody who borrows on, say, Aave, be a platform like that. You could borrow in the 3 different coins, and if ever there's a situation where you've got Tether, and USDC or DAI has a temporary depeg, you can then use that, swap back, and then the day after borrow again, and you've benefited from the
there is a lot of risk in that, obviously, but I don't think that needs to be said.
If you've got it's talking about if you've got a loan where you are safely collateralized, because of course the opposite risk can happen is that you could collateralize a loan with DAI, and this is what so you could have DAI, and then DAI drops to 90 cents. Well, your collateral's dropped 10%, so now you're closer to liquidation. So that's where kind of there is some risk. Obviously, there's risk in all.
I mean,
leverage and borrowing.
Obviously, if you're looking to borrow and collateralizing, like against your Bitcoin, like me, I know there's a lot of people that take loans with Bitcoin as collateral, or wrapped Bitcoin or whatever. Around the peaks, towards the end of an explosive long-term rally like we had back in 2021. Don't do that. As far as I'm and I don't really mess with loans that much, because I feel like I don't want to owe money. I don't like debt personally, unless of course it's reinvested. But I don't like to. Either way, I'm not gonna have to explain myself with that. But if I were to borrow against my Bitcoin, I would do it towards the bottom of the just after there's a trend reversal and let's say the start of a bull run. That's when I will borrow against it for sure. But not when it's and I wouldn't borrow more than 25% the value anyway. But either way, I think borrowing on DeFi has its risks, obviously, as we just said, but there is some benefits to it too, obviously. But okay, let's get away from that. So
it was just a fun a feature
yeah.
of how the market worked, is that it did
Oh yeah.
enable that
I mean,
kind of move.
I would have been
And
super happy if I could pay off my mortgage with 15%. Like,
yeah, and what you've got there
discount.
is you have within that, you have the motivation for people to actually buy USDC, because you'd have seen people that would go, well, I think USDC is worth $1, and they would sell their USDT and buy USDC at that dislocation, which obviously brings everything back to parity. And
Yeah.
so if you can repay loans, or you can borrow cheaply in a currency, think about taking, borrowing some dollars when USDC was at 90 cents.
Yeah.
And there's ways, there's opportunities that you can kind of make with that.
I mean, you can do that. You can do that in, like, you don't have to do DeFi for that. I mean, for example, me being in Sweden, if the Swedish crown suddenly explodes against the dollar, or the dollar stops dropping, I could mortgage my house for Swedish crowns, buy dollars with that, and then wait for the turn for it to go back around, because dollar is always going to be more, it's going to be stronger, and then I'll just buy crowns back with Swedish crowns back with that dollar that I just had.
As long as you're on the right side of the trade,
of course. I mean, obviously there's people that do that, which is a valid thing to do. I don't really feel like I have time to mess around with that. I'm too focused on the crypto space. But maybe in the future there's something I can do. Yeah. Which was CBDCs, and we have previously, Rob and I, in private, we have had discussions again for CBDCs, and because we enjoy obviously talking about stuff, sometimes we have very differing thought processes, which is why we talk, and this is why we want you guys to talk to us and everything. So we discussed CBDCs quite extensively, actually, a while back, and we kind of came to, I was going at it from one direction, and Rob was taking another direction. I was really focused on the dystopian aspects of CBDCs, and Rob was talking about the possible benefits with CBDCs, and there are some as well. And I thought we should try to have that discussion a little bit here, just because I feel like it can maybe take away some of the edge around the topic for a lot of people. And the reason to why we do want to talk about CBDCs is because in the past few days it's been a lot of talk about, not a lot, but there's been some talk about how CBDCs could be a solution to some of the problems that is currently happening. And on top of that, Circle's CEO, I believe it was, came out and said something about maybe we should have a digital currency, kind of nudging people towards using CBDCs, or using Circle's stablecoins. And I think maybe he's trying to say that, hey, we would like to be the CBDC for the United States, which is probably not going to happen, but he's probably nudging that way, which would be extremely beneficial for Circle, obviously. But so on the topic of CBDCs, everybody in the chat, please give us your thoughts on CBDCs, what the pros can be, what the cons can be. And I will just start it off by saying the dystopian possibilities with the CBDC. Let's start with that, Rob. And say, yes, there are some very dystopian elements to CBDCs. Basically, simply put, we have it's programmable money, right? Which means that if the government wanted to control the way you spend, how much you save, what you can spend on, and all these things, they could basically do that. If the government, for some reason, think, oh, we don't want you to buy Bitcoin, they would just block payments for Bitcoin, which is horribly bad.
That sounds really, really, really dystopian. And what is super duper duper dystopian is that they can do literally every single thing you just said right now.
Yes,
already.
Exactly. And that was where we wanted to get to with this discussion as well. It's like some of these things that are dystopian with the CBDCs. And I think, if I remember correctly, Rob, my argument against CBDCs is that, they can already do all these things to a large degree. They couldn't really stop us from sending our money to an exchange and not saying what we're going to buy and then buying it. They couldn't actually block the transaction itself. They could probably do that with CBDCs, though. However, with a CBDC, if we're going to change the monetary system and whatever currency we're going to be using in the world, I think we should aim to be an improvement on dystopian aspects rather than a downgrade or staying the same. So yes, we can. They can still already do these things, many of these things, to a large extent with CBDCs and what we already have right now. But instead of upgrading to CBDCs, which for me would be a downgrade in that aspect, but an upgrade in other aspects, why don't we just make it better and not add to the dystopian possibilities? That was my argument.
And who's this then is the argument that, who's to say there will be any dystopian elements? And this is a genuine question. It's not a trolling question. It's just because somebody has the capacity to do something doesn't mean they're going to do it. There is no there is no real suggestion beyond, they will have the capacity to, that they're going to start freezing your CBDC account for frivolous things. Because, as I said, we already have the ability to freeze bank accounts, and an example of that, of where that has been applied, would be with the Canadian trucker protests last year. And now, so it's absolutely, completely regardless of what you think of the political side of why they were protesting and their right to protest and everything. I'm not entirely on the fence with why they were protesting, but I have sympathies with them. But at the same time, I will automatically defend someone's right to protest unequivocally. What we had was a situation where people were having their bank accounts frozen for being present at a protest. Now, if you are being a genuine criminal, then, and you've committed crimes, and there is a case for having your bank frozen because you've committed a criminal activity, okay, fine. But no, not just as a punitive punishment, but they did it anyway. And then people started sending them Bitcoin, and there are examples of people who had sent them Bitcoin having their bank accounts frozen. Now that is a gigantic and ridiculous overreach from the Canadian government. Didn't need a CBDC to do it.
No.
So there's it. The dystopian side, it already is there. So on its own, I don't see it as a counter argument on its own. I accept it as a contributing factor, but I think there needs to be more to the argument before I would go, okay, this would turn me against.
Yeah, no, I think where my head is at is where it's like, there's a reason to have like Bitcoin, right? It's like, I control it, it's mine. And if they, like you said, they can already do these things. So if we're going to upgrade, it's not really an improvement at all on those aspects. Bitcoin is a massive improvement in Bitcoin is a massive improvement in those aspects compared to what a CBDC would be compared to what we have now, right? But like it's we're gonna get to the good points of the CBDCs too, and which I think is kind of what we're gonna lean into now, because there are some really good things about it too, possibly.
So an example of what we have is, so we're talking about it right now. We've talked about bond markets and we've talked about bond liquidity and the provision of how the Fed actually gets money out into the system. Now, as I said here, if there begins a range of bank runs and they've promised to bail out all depositors, that is helicopter money. That is just taking cash which doesn't actually exist in the system and adding it to the system. That is just straight up MMT, off we go. Now, that can be done again without CBDCs. What you've got the issue with is how the money is currently lent out, which is when the Fed does QE, they say they create these bank deposits. These bank deposits can't be withdrawn. They stay with the bank's account with the Fed, and they can use that money to buy assets with, to buy bonds, and then using those bonds or using those assets, that gives them the collateral with which to issue new loans. So there is a step whereby the Fed cannot get money into the system. They cannot get money into the hands of people, even when the economy desperately needs it. And there are periods, whether if you're a, say, laissez-faire capitalist that believes in that any and all government intervention is bad, well then you'll probably disagree with this statement. But if you think that the government has a responsibility to step in and do what they can do in order to prevent a crisis, well then it's that if they feel for whatever reason they have to do something, then they need the provision to do something. And CBDCs do actually enable people to they gives them additional tools to do what needs to be done. A good example of that for the UK is we have winter payments for pensioners. So people who are retired, if the temperature drops too cold, temperature is too cold for a certain period of time, there are a winter payment allowance. Now that can be done CBDC immediately. Cut out all the bureaucracy, cut out all the everyone. It could identify who actually needs this payment. Maybe some people don't need as much. Can you means test based on people's incomes and outgoings? Anonymized, they don't need to see anything about who the human being actually is, but they can look at it and go, these people qualify for a partial payment because their revenue is their incomes and outgoings are this. These people qualify for the whole lot. These people qualify for none. That can be done completely anonymously using our data. Yes, it will use our data on how our spending habits go.
Yeah.
Don't you dare bitch and moan about that if you've ever used Google.
No.
It doesn't. Yeah. You can't be a hypocrite that much of a hypocrite where you say I have accepted, or whether or not you willingly accepted it, you accepted the fact that these giants utilize your data all day and all night. Some people obviously will take care of that and not reveal their data, but let's face it, we all use Google, so we're all complicit there. The fact that the government can do it and then actually instigate sensible monetary policy on targeted monetary policy where it's actually needed within the system, which right now they simply don't have the data to support and provide, that is incredibly powerful.
Yeah.
How much interest is? I'm sure I could ask anybody in the chat how much interest your current account makes, how much your savings account makes, and it's if anybody's getting 1%, I'll be absolutely amazed.
Well, currently there are pretty high interest rates because the banks need money. I think my mom had like 1.8%, and that's high compared to what it normally is, right?
But so either way, that's way below bond rates. That's way below.
For sure.
So as an example, any money, if you have CBDCs in your bank account, you will receive daily interest equivalent to the Fed funds rate.
Yep.
Therefore, we're going to say, no, this is the interest rate, and therefore we are going to increase the money supply in your account by the interest rate. What that's going to do, during periods of high interest, there will be more money going around, and that will incentivize lower interest rates. It becomes you can algorithmically control the money, and my looking at the last 40 years of policy where money has been controlled by a bunch of grumpy old men in suits, predominantly, then I'll take the algorithm, to be honest, because I know that these people keep fucking it up.
Yeah, I think what's important with the CBDC discussion is to try to not just see the dystopian side and try to not just see the upside. You have to realize that there are very many variables you need to think about. The same way when you're looking at maybe investing in an asset, it's like you're not just going to say, oh, the price is going up, I'm going to buy here. Well, you're going to need to know if it's a good asset, like we did with the either way. What I was trying to say here is that this is why we want to have these discussions, because most of the crypto space, or especially Bitcoin fanatics like Bitcoin maxis, CBDC is the worst thing ever that has ever existed and can ever exist. because they're only thinking about the downsides of it, the possible downsides, but there are also a lot of possible upsides to it. And this is what I think for people watching, when you discuss and when you start researching CBDCs on your own, and really, if you really want to get into it, make sure you actually look at all the variables and not just the bad stuff and then get stuck in that, because you'll get tunnel vision pretty quickly. And this is true with anything. So this is why, Rob and I tend to try to have kind of differing arguments when we sit here and do these things. But what's happened with us is, and I'm sure people have noticed that too, it's been here for a while, that we might go into a discussion, me being, from this angle and Rob being from this angle, and then at the end of the discussion, we have a conclusion where we can sit down and both think, yeah, so here's what the best version of this would be. And one of those discussions that we need to have, and I think we need somebody who is very good at both Austrian and Keynesian economics, maybe Saifedean Ammous, to have Saifedean Ammous on this show and sit down and see how we can merge Keynesian and how do we merge Bitcoin into the monetary system that we have right now. How do we get a good hybrid working? But that's a discussion for later.
You'd have to unblock me on Twitter first.
Yeah.
Don't worry, he does have me blocked. So.
All right. Well, either way, that's a discussion that we would love to have.
Yeah, and it's a discussion which, if it has, they say there are merits to both systems. If there wasn't, then we wouldn't we wouldn't have these two different systems. If there was only one which was good, then that's the one we'd be using. And it's not entirely, not getting into the discussion too much, but there is the move towards a more Keynesian economic way of operating the world has had, numerous issues, but it has led to a period of, it's coincided with a period of incredible economic growth, incredible sort of levels of relative technological growth, but also stability, which maybe it was just the technology and it's not the money at all, and technology would have worked beautifully on a gold standard. Yeah, but it's always the question of the gold standard is how do you borrow, because the downside risk of borrowing becomes incredibly high when would you loan someone your Bitcoin?
Yeah, but it's like the counter argument to that would also be from somebody who is much more versed in these subjects than I am. If I feel like, is like, do you really need to borrow at that point in that monetary system?
Unless you're an early adopter, yes, you need to borrow, because if you're talking about Bitcoin being a past its current hyper volatile stage, there's the volatility levels are dropping consistently over years. You can see the drawdowns are getting smaller, the rallies are getting smaller. Eventually, I see Bitcoin moving into becoming basically a stable asset which grows relatively to the amount of monetary debasement in the world. That would be how I see it happening. And so if you are going to, if the dollar's depreciating by 5% a year, Bitcoin would roughly go up by 5% a year, into maybe 20% a year, because it's got, liquidity limits or so. But you are going to, if you're only going to get, say, 5 or 10% per year from this yield, and this is your cash, we're talking about a replacement for a fiat system. This Bitcoin is now your cash. If anything you want to buy, anything you want to invest in, if you want to set up a business, if Bitcoin's making you 10, 15, 20% per year, your business suddenly has to make a hell of a lot more money to be economically viable versus just holding the Bitcoin.
Yep.
And this is the major problem with a gold standard, is you need to persuade people to give up their gold, to lend it to somebody who has risk attached to their, it says, I'm going to take some risk in order to grow a business which I believe will be profitable. There is a risk of loss in that. And if your money increases in value every single year, then that loss and that risk compounds, and it gets more and more and more dangerous to have this this money lent out. If you have a currency that has, say, a little bit of inflation every year, say about 2%, then what happens is you're not so worried. As long as you're getting a reasonable yield, you can have both stability and profit at the same time. Now,
right.
So there is a very, very clear advantage to being able to create money that I promise to pay you back later. The risk is, because if I've created the money out of thin air and promised to pay you back, but over a period of time, and I can meet my obligations and pay you back over a period of time, well, I've taken my debt and I've swapped it for assets. How much money have I actually created by the time I've paid you the loan back? I've created zero money, because the whole creation of money in a fiat system is you create a double bookkeeping of, you create an asset and a liability of equal amounts. And when you pay off a liability, when you pay off a debt with some cash, you destroy that cash in the process. So it's a proper Keynesian system. The monetary supply will expand during a boom and contract during a bust, but it would do so sensibly, and it would do so within within limits.
Yeah, that's the thing too. Like, for it to work, it has to work perfectly, basically, right? So this is a discussion that I think we
it's probably 2 hours on its own.
This is a very long discussion, and we need probably somebody who is extremely versed in let's say the Austrian economic school of economics.
I'm good enough.
Yeah, but okay. So either way, we need to start rounding off sooner. So I was hoping that we could just touch on the flight to safety Bitcoin thing.
Just one very, very quick thing first, which is, if we want to talk about elastic supply and how a Keynesian monetary system can actually work, or how it can actually be represented, look at the stablecoin market cap, where we have had this. I know people would say, yes, Tether's a scam, and the cash doesn't exist, and all this and all that. So no, the crypto market is growing, and therefore the amount of liquidity required, the amount of cash required to facilitate the transactions for that growing amount, also increased. So the growing market cap led to a requirement, a necessity of the growing of the money supply. If you don't grow the money supply, it's like saying that you had no USDT pairs, you only had altcoin versus Bitcoin pairs. And that would very, very much change the dynamic of the market. The addition of USDT pairs is relatively new. I remember trading multiple coins in 2017 that just didn't have USD pairs at all. You could only trade them versus Bitcoin. And so, and now that's completely changed the market, having dollar pairs, because the Bitcoin is inelastic, whereas the dollar is elastic. And the stablecoin market is a pool of liquidity to move in and out of within the crypto space. And currency needs that for within an economy.
Yeah, for sure. All right. Okay. Last point. Now that we saw this huge pump happening after huge pump, we had a big pump in Bitcoin's price, specifically Bitcoin. We had some major pumps actually in most coins, but Bitcoin usually, if Bitcoin goes up 5%, everything else goes up 15%. But this time we had Bitcoin going up, I think it was 35% or something across from this dip bottom that we had to the top was 35% in the span of a couple of days. And I think we mentioned earlier that one of the possibilities, and yes, there was a lot of short squeezing happening. And another argument was, could it have been that the depositors from the bank bailouts decided to move some of their funds over to Bitcoin because that felt like that was safe in case the banks were to crash?
Maybe some.
I mean,
100 million, couple 100 million, who knows?
Yeah. So what I'm thinking here is it possible that one of the narratives for Bitcoin has been not been flight to safety, but stored of value. But if a major crash is about to happen, do we think that there will be a demand for Bitcoin at that point? Obviously, there would be a lot of sell-offs, but for like the regular guy, like myself, for example, personally being so bullish on Bitcoin as I am in long term, if I knew that my bank was going under, that I wouldn't be able to take my money out, I would probably move it to Bitcoin at that point. That's me, right?
Yes. Okay.
So the question is, how many people do we think that's something that a lot of people are walking around thinking about?
There will be some people who have been thinking, maybe they had a conversation with someone like us a few months ago, and they did a bit of research, but I'm not really sure on that. Oh, the chart looks horrible. It looks like it's going down. No, I'm not really gonna buy any of that. And now may go, actually, maybe I should have a bit of a think about this. And they are I doubt. You've got to think, does something like this cause people to suddenly just throw their life savings into Bitcoin? No,
not life savings. No.
But what it does is it's just that little shift of people who've heard about it but haven't acted. It causes some of them to act. Some people that have kind of heard about it but never looked into it, they start to look into it. People that have never heard about it hear about it. It's just one little shimmy across the queue of adoption. It's just that slow move of people into it. Now, I don't really buy this. Yes, people are buying Bitcoin because this. I see it. Yeah, there is always an underlying bid for Bitcoin from people DCAing, monthly, weekly, however it is. There is always a long-term trend. You can see by the on-chain metrics clearly show when people are accumulating. It's not rocket science to see periods when Bitcoin is cheap. It is not hard to look at Bitcoin right now and see it is cheap. Can it go cheaper? Oh yeah, definitely. Could go a lot cheaper. Is it cheap now? Yes. Not financial advice, but yes. And so it's would some of people have done it? Yeah. Do a lot of people do it? No. I think it was mostly just a narrative-led short squeeze on top of the USDC. The USDC collapse basically encouraged the sell-off. It encouraged this drop below support, and then this news that the depositors being made whole. Suddenly, everybody gets bull market vibes and think that we're in April 2020 again, and we ain't. We're not in that by a long shot. And even if it did happen, if all of a sudden we wake up tomorrow and 8 banks are failing and the world's on fire and there's talks of a $3 trillion bailout, Bitcoin will probably go up. But do remember that hundreds of thousands, millions of people may end up losing their jobs around the world, will be hit by horrible hardships. So just temper celebrations in the event that we do get the Fed pivot, which I don't think we're getting yet. But if we do get some real serious contagion, then yes, we'll pivot. Bottom is in. Michael Baru is right, and bull market, off we go. It will take an ungodly amount of money printing, and that will create huge problems because we ain't in a position where we can handle it. But as I said, Fed is stuck between a rock and a hard place. They're screwed either way. We're screwed either way. Fucked all the way down.
Yeah. Well, okay. So hopefully, as crypto peeps, we would hope to see continued adoption of Bitcoin. And I'm just looking at a chart right now, and it's the number of the number of total addresses on the Bitcoin chain right now is almost 1.1 billion, which is a lot of people.
That is a lot of people.
And obviously there's people with several addresses. I mean, I know I have several Bitcoin addresses, but still, continued growth like this, like there's almost no difference in address growth across if it's a bear market or not or whatever, the adoption line for active addresses is it started exploding in 2004. It started growing really fast in 2014, 2015, 2016, and then
Could we see?
right, yeah. I'll just show it like this. This is just no, that's yours.
That's mine.
Yeah, I wonder if I can actually. Yes, I can. So I'm just looking here. These are the orange lines are addresses. Obviously, it started growing. It's almost like you can see the adoption curve almost.
Yeah.
Well, obviously you see the adoption curve, but you can start seeing the S curve soon. It's like you see this start of the the early adopters. In a couple of years, like let's say 30, we should definitely remember that we said this now, and we're gonna see if we can see that if it's changed direction from 45 degrees like this, or if it's slowed down,
or it takes a leg up.
Yeah. I mean, if it
this is
this is basically 45 degrees right here.
Yeah.
But
what we have talked about here, say that as a potential, however unlikely, whether or not it happens, as a collapse of the bond market. The bond market is under stress. The bond market is not got a good thing coming for it in the next year or so, and this extends outside the US. I know we've been very US focused this sort of episode, but this extends to every country around the world, and it extends heavily to a lot of countries and corporations and people who hold US debt but earn money in currencies other than the US dollar. Because in order to finance their debt, in order to meet their debt obligations, they need to sell their own currency and buy dollars. And when we talk about collapses in markets and liquidity drying up, there is no, in a sense, not wanting to insult anybody's home currency, but national currencies are shitcoins. That they are shitcoins, and the US dollar, by comparison, is it's the US dollar. It's Bitcoin, but it's the US dollar. Things go in and out of the dollar. When the shit hits the fan, when things turn, when liquidity dries up, there is nobody to buy these lesser currencies. And if you've got bills to pay in that currency, you can't pay it unless somebody gives you dollars. And who can give dollars? The Fed.
Yeah.
And CBDCs would allow the central bank to issue currency outside the US, which you talk about this layer, as I talked about this layer of getting money from banks into the people's hands. You can add an extra layer of complexity when that goes for foreigners who have to get their money. They get this money out of the US, not only out of the banking system. CBDCs will actually provide a huge method for a stream of liquidity that's needed, that's absolutely essential to keep the current financial system working as it is. If they don't do it, the system's going to collapse as it is. Well, yeah. So this is that's always the question.
That's the whole thing. It's like the level of trust that's needed is the annoying part, but.
We can talk about the dystopia of Google, Facebook, Twitter.
Oh
Microsoft,
no. What I'm saying is what I said about the CBDCs before was that in order for CBDCs to be all these things that are good about them, that means that the people in control have to be trusted to do that, and the way that they're treating the system right now doesn't really incite much.
Absolutely not. So this is the tools of dystopia aren't necessarily the problem compared to the dystopian people. Guns are a tool of dystopia. They can also be a source of liberation. It's depending on which country you live in.
Yep.
So, but it's very much the gun itself is a tool. It's for right or wrong. It is purely a tool, and CBDCs will be a tool as well. The way that they're used, if they're used poorly, there'll be problems.
Yep. All right. So conclusion about this whole stream. Market's fucked, and yep, great. Good luck.
None of it makes any sense, but meh, not good.
But meh. Yeah. All right, so we're gonna wrap this up now. It's been 2 hours. It feels like it's not been 2 hours, but it has.
Oh, I feel like you've got to end it exactly on 2 hours. Come on, go.
Okay. So, guys, everybody watching, remember to subscribe, leave a like, leave the notification thing, and share it with everybody you ever know.
Oh,
Okay,
you missed
bye.
it. Too late.
Damn it. You share this. No, it's too late anyway. Share this
Oh,
with
we can
everybody
stay
you
on for
ever
another
know.
hour then, yeah?
I can do 2 more. No, I actually gotta go. So,
Yeah.
But yes. So everyone, thanks for being here. Thanks for all the chats. Thanks for hanging around. We'll see you in the Discord after this as usual. The
Thank
next
you,
stream
everyone.
is gonna be on Saturday. It's gonna be a long one too. And we're not sure. Oh, we'll see what we do. We'll just keep an eye on the Discord. So cool. We'll see you then.
Bye.
Bye.